The stock market is about to crash, and we just hit a 2,600% winning trade on Disney last week, and I think this is only the start of this crash. So we're going to go over the major catalysts happening this week and what you guys need to know, and potentially how you could become an overnight millionaire by listening to this video. So let's dive into it. If you guys find value out of it, hit that like button for me and subscribe to the channel, but let's get into the info. This past week was the worst week since the crash of 2020. And if we do take a look at the S&P 500, you guys could see that it's just a straight knife going through butter, straight down. And that's exactly what we seen during that first week of March of 2020. This is likely to get a whole lot worse, and we have big catalysts next week, but you really have to know why, because nobody is telling you this, but we are going to here in this video. So the catalysts for next week are going to be big company earnings. Microsoft earnings are January 25th. That is on Tuesday. We do have the FOMC meeting from Jerome Powell, where he will be giving his speech to the public on what they expect to do, how much they expect to raise interest rates, if they are going to possibly next week. That's all on the table. And then we do have Apple earnings the day after that, which is going to be January 27th. Now, what market participants are doing and what the algorithms are starting to price in, and what nobody is telling you, is that with all of the stimulus over the past 2 years, nobody expects earnings to actually go down at these companies, but that's exactly what is going to happen. You're going to see negative years compared to the last 2 years this upcoming year for 2022 as far as revenue at Apple, Microsoft, Facebook, Nvidia, Tesla, all these other great companies. So the last thing you want is high inflation, a Fed that is tightening and sucking money out of the economy, and earnings going down at these companies. So what is going on right now, and what no analyst seems to fully understand, is that these algorithms are pricing in a weaker than expected 2022. We're going to get into some of the data points that prove exactly what I am saying, but that is the general consensus here, that stocks like Apple, if you take a look at this chart, this is pricing in an even better 2022 than 2021, and certainly better than 2020. And if those expectations start to get derailed by the earnings that come out, like I said, the Microsoft earnings and Apple earnings this upcoming week, that's where you start to see the real pain. And that's why Apple could even fall back down to this 120 to 115 price range. But it is very important to keep in mind, I do not think Q4 actual revenue numbers that we're going to be getting this upcoming week are going to be bad. I do think they will be good, but I think the guidance that these companies give is going to be bad. So in other words, it does not matter what happened last quarter, it matters what is going to happen in the following quarters. And if Apple, Microsoft, these large companies that control over 50% of the broad indexes start to say, hey, we're seeing demand really slowing down, we might have to start scaling back production, then that's when you start to see the real pain in the markets. And I like to say this analogy all the time. If we knew an asteroid was going to destroy Earth in 6 months with a 99.9% chance of it actually happening, then you would see the markets go down probably 85% the next day after that news broke. Because why would you invest your money if the world was going to end in 6 months? It doesn't matter what happens in the next 2 quarters or what happened last quarter if the fucking world is going to end. So that is really why this is so important, and that's really what I want to stress to you guys, that even Apple alone controls almost 12% of the broad markets. But really, to bottom line that, is that big analysts, big banks, your largest hedge funds have not realized that revenue is going to go down dramatically because they already make a lot of money. They don't realize by giving out stimulus every week, every month to people in the forms of stimulus checks, child tax credits, in the form of unemployment insurance, that gave your regular people that drive earnings and buy products at, say, Apple, is going to slow down dramatically when that money is unavailable. They have not realized that yet. Once that is priced into the markets, you will see the markets rapidly take a move to the downside. And that is where you guys can become multimillionaires and make a lot of money by hedging out your portfolios now. Obviously, I am not a financial advisor, but I'm going to be showing you in this next segment of the video what I am going to be doing to hedge out my portfolio to make a lot of money. We are also going to be going over the data on why I am saying this, because I am not just implying this is going to happen. There's actual data to support this is happening as we currently speak. This is the personal savings rate, and this is the percent of money that people are saving. Right now, it's at 6.9%. If we zoom in from 2000 until now, you guys will see that this is under pre-pandemic levels. In November and December of 2019, before COVID, it was at 7.5%. Now it's at 6.9%. So what this means is people are saving less money, which does imply that people are spending more money and not able to save as much. And if you're going to be buying products like iPhones and iPods and iPads and AirPods, all these other things that you would typically buy from large companies, or like Xboxes from Microsoft, it's going to be coming from your savings rate. And the fact that this is dropping is very alarming once we are heading into what should be the best year that we have seen. That's what analysts are kind of pricing in for the stock market. So not good. What we are seeing right here does imply that spending is starting to slow down. Now, some other things that I am looking at, and this is more, it's Google Trends, so it's not like 100% factual, but it does give you the best representation of data up to date. So we're looking at iPhone search terms, and you guys can see that these have basically fallen off. We are at our lowest levels in 5 years as far as people searching for iPhones. We are at a 30 for Google Trends. Just back here, September 12th through the 18th, 2021, we were at 59. And throughout the past 2 years or so, we have been higher than 30. We have never hit 30, but that's where we are at right now. So people are obviously not as interested in buying new iPhones. They're not interested in buying new products. If you look at any search term, if you look at Xbox One or anything else along those lines, it's down. It's at its lowest level in like 5 years, like we see with iPhones right now. It's never been lower. And this is something we have to pay attention to, because stocks, companies, a stock is just a representation of a portion of a company that you own. So if earnings are going down, people are not buying as many products from these companies, the stock valuations must come down. And that's what we are going to see happening. But the large people, the people that control the markets, the big money, they aren't as keen to this data that we are going over here in this video. So let's take a look at something else. Home loans and auto loans. This is already at a 5-year low as well, with auto loans and home loans being at about that low 40s range. The average for home loan is 66 and the average for auto loan is 68. Lower than 5 years, where people should have all of this extra money. It's not the case, and people are not spending as much as they used to. And as well as that, the December retail sales numbers were expected to come in at 0.1% to the positive. They actually came in with a negative 1.9%. People and analysts just chalk this up to being, hey, people bought more things in the month of November because they were worried that shelves would be empty. I am not as convinced that is the case, because in the month of December, that was really the last month where you got the child tax credit, and people started to save more money because they're like, hey, we're not going to be getting all this extra money. We should probably dial back some of our spending. So when you add all of this together, it definitely looks like spending and revenue is going to go down at the largest companies. Now, how would I actually hedge out my portfolio to make a ton of money, possibly become an overnight millionaire? Well, I'm going to be depositing about $3,000 more, so I will have $6,000 in cash, and I will be likely hedging that out with $1,000 hedges across different stocks and indexes. So what I am really looking to do is buy the February 18th, probably the Apple puts, some that I see right here, for like the 135 put, and I will likely sell out if I can make them free by earnings, sell, half of the contracts, make it free, ride the other half into earnings, or I might just hold them all depending on how it looks and what is actually happening in the broad markets. As well as that, I'm looking at some S&P puts because I think the S&P 500, if Apple has bad earnings, it could fall to 400, if not worst case scenario around 370. And if you bought, let's say, a 435 SPY put for February 18th, sure, that's going to cost you. Let's just take a look what it's going to cost you. Let's just take a look. Let's see. So for February 18th, let's see, SPY put. Let's do the 435s. 435s. It's going to cost you $1,000. Your break even is 423. If the SPY went to, 370, you're going to be looking at over $5,000 of profit on those contracts. But probably what I would do is probably go to the $400 SPYs, and that's only 335, or possibly go even closer. Less time, I should say. Go to, let's say, the February 4th, and then you'll get a much better deal, and these contracts will go up a lot more if you do see a big move in the markets. Look, you can get a SPY $400 put for February 4th at $161. That does not look like a bad move. And then I would probably buy some Facebook puts, some Microsoft puts as well, because I think the large cap stocks are going to go down dramatically more than some of your stocks that are already beaten down. Like, why would you not buy a SPY put or an Apple put or a Microsoft or Facebook put when these stocks are only down minimally? Or if it's like Apple, they're still up over the past 3 months. Why would you not buy puts on those stocks rather than like a PayPal or something that's already down over 60% from its highs? So that's my thoughts. That's exactly what I'm going to be doing. Hopefully it does help you guys and make you guys a lot of money. If it does, if you guys found value or like the insight that was provided to you here in this video, hit that like button for me. Consider subscribing to the channel and let me know down below in the comment section what is your thoughts for this upcoming week in the markets and what are your hedge trades that you have on right now. I would love to hear from you guys. And just if you guys were curious about that trade that I did tell you earlier in the video about the Disney $2,600 put, let's just take a look at that just so you guys know I'm not BSing you here. You guys can see I bought two 147 puts, which this was risky, so I always keep it small because Netflix earnings were coming out. I figured, hey, if Netflix had bad earnings, it's going to affect Disney as well. I bought two of those, and that was January 20th. I sold one of those about 1 hour later for $69, made the extra one free, and then I held that one the next day. Disney fell through the floor and sold that at $870. So that was $30 into $900 in profit. So that's the scoop. That's really what you guys need to know. Not too much else to add on this. You guys get the idea. Earnings are slowing down, valuations will compress, and the markets will fall dramatically. So I'm going to get out of here. You guys enjoy the rest of your day. I will see you in the next one.